In the investment world, there are no certain outcomes, and while some investment strategies have historically been more successful than others, no one can predict the future. The truth is that investing is much like piecing together a jigsaw puzzle. Large pieces can be lost if not placed in the right position. Similarly, even the best strategies can result in loss if basic investment principles are not followed. So there are some basic investment principles that apply to all investments. But of course, there are also many other factors to consider. If you're unsure where to begin, here are some tips to help you start. Number 1. Invest for the long term. One of the most common mistakes investors make is to invest without proper research and planning. Investing for the short term, especially in equities, is one of the biggest shortcomings of current investment strategies. The stock market can be unpredictable, and it's easy to panic when things don't go according to plan. Investors are often tempted to invest for the short term because it's easier, but truly great investors realize that if you purchase an investment at a favorable price, it can take time for the market to recognize that value. Unfortunately, many equate investing with day trading and don't stay with investments long enough to see them realized. Long-term investing is a crucial investment principle. That's why it's essential that people invest their money and keep a long-term perspective. One of the main advantages of this type of investment strategy is that it avoids the volatility associated with short-term investments. Disciplined and patient investors in difficult times are rewarded with higher returns over time. With this investment philosophy, it's possible to develop an investment portfolio that grows for decades, providing significant income and cash flows. The idea behind long-term investing is to give investments sufficient time to grow at a compound rate. Admittedly, long-term investing can be a little scary because there's no immediate gratification, but it's one of the most important principles to understand when investing, as it allows for steady, continuous portfolio growth and reduces risk. So invest with a focus on the future, not short-term gains. Number 2, don't lose sight of your investments. Many people lose sight of their investments, either because they are afraid to face the mess in their portfolio, or because they don't want to admit that they should have invested more money in the stock market years ago. Either way, it is easy to lose sight of your investments throughout your life. You can forget what you have and lose touch with what is happening in the market. This may not seem like a big deal, but it is important to stay on top of your investments, or you could be caught off guard by a sudden change in the market and lose money. The reality is that investors who maintain an informed and well-structured portfolio are better at predicting market changes and take less risk. Therefore, to ensure that your investments are performing at their best, it is essential to monitor them regularly, which can be done by reviewing their performance on a day of the week of your choice, and to do so in a disciplined manner. In doing this monitoring, it is important that you take into account all aspects of the investment, including company performance, share price performance, earnings per share, etc. The truth is that there are many ways in which an investor can protect himself from damage by managing his funds carefully and monitoring his investments. But the most important thing is to keep in touch with them and not lose sight of them. Keeping track of your investments is therefore the best way to know when to sell your shares and what to invest in next. Number 3, invest logically, not emotionally. Often, investors try to outperform the market and invest emotionally or gut rather than logically, which can lead to poor financial results. Investors should focus on staying within their risk tolerance and investing in diversified mutual funds. There is no need to overcomplicate investing. However, there are 2 main reasons why people invest emotionally. The first is the fear of losing money, and the second reason is due to the desire to have wealth today, rather than waiting. Keep in mind that investing is not about getting rich quickly. It is not about investing all your money in one stock, nor is it about trying to time the market. Investing is about having long-term goals, and it is important to invest logically, not emotionally. While it is difficult to follow a strategy when you see your portfolio fluctuate from day to day, the reality is that emotions are fickle and can lead to irrational behavior, such as investing too aggressively or not diversifying investments enough. While it is common behavior to want to invest our time and money in things we enjoy, it is also important to invest logically and unemotionally to avoid mistakes and make smart decisions. Number 4, investing is a process. You may have heard the saying, time is money, and it couldn't be truer. That's why to invest successfully, you have to be willing to put in the time and effort. When you do, you will not only increase your success over time, but also your risk. The truth is that investing is a process. It takes work and dedication, and it is not something that can be done in a few hours. However, some people try to get rich quick and end up losing money, or worse, going bankrupt. Understanding the various risks and rewards, researching your options, and deciding on an investment plan can take time. Mentally calculating the likely financial outcomes, adjusting the plan accordingly, and sticking to it over the long term is critical to successful investing. The truth is that it is easy to get caught up in the excitement of investing and want to withdraw your money as soon as you see some growth. However, if you don't wait, you can miss out on potential profits because the market can change course quickly. To invest wisely, you need patience. Patience is a virtue, and it is important for any investor. The reality is that it takes time and research to see how an investment will evolve. So if you want to invest in stocks, you should start by doing your research before you invest your hard-earned money. Number 5, adopt an investment strategy. The hardest part of investing is deciding what to do. Should you invest in stocks or bonds? Should you invest in a savings account or a certificate of deposit? Should you invest in an index fund or in stocks with growth potential? The truth is that with so many options available, it is easy to make a decision you are likely to regret later. So if you want to avoid regrets and make smart decisions with your money, it's important to have a strategy that works for you. Going into any investment without a plan leads to a lot of confusion and the potential for bad decisions. That's why, in your strategy, it's important to know your level of risk tolerance, as well as the time frame in which you are willing to invest, so that you can create a plan that suits your needs. Therefore, when choosing an investment strategy, it is important that it is one that works for you. The key to success is to start with what you are comfortable with, and then gradually increase your risk tolerance as you gain experience with better strategies. Remember, a successful investor needs to be smart in their investments and have patience, but they also need a plan and a good strategy. Number 6, investing in what you know. Many people invest in stocks or other financial instruments that they do not fully understand because it is easier, but it is not always the best option. Investors should take their time and do their research before investing, because when you invest in something you know, it is easier. Without a doubt, the idea of investing in something you know is the best way to approach it. It is important to know the company you are investing in and how it works, because that knowledge will help you make more informed decisions, which is crucial to have the best chance of getting the maximum return. Many people make the mistake of investing in something they don't understand, but it is better to invest in something you know. Having knowledge about the company before investing can lead to higher returns, lower risk, and greater satisfaction. It is very important that those looking for viable investments spend time researching what they are considering. Therefore, if you invest in something you know, your chances of success are much greater, as it is easier to determine whether it is a good investment. Number 7, diversification is vital. What are the factors that help determine risk tolerance, and how important are they in building a diversified portfolio? An individual's financial situation, age, and income level can influence their risk tolerance. Understanding these factors is the key to creating a well-balanced portfolio that will stand the test of time. Before investing in anything, it is important to take the time to analyze your current situation and decide what you can afford to put at stake. Diversified portfolios are a good way to minimize portfolio risk. A diversified portfolio is made up of investments of various types, which may include stocks, bonds, treasury bills, gold, and others. Diversification is achieved by investing in different securities or asset classes with low correlations, which gives you a better chance of success, because while the price of some assets may go down, the price of others may go up in value. Therefore, it is important to diversify your portfolio according to your risk tolerance. For example, if you are a conservative investor, you can invest in utility stocks. If you are a moderate investor, you can invest in a combination of stocks and bonds, or in mutual funds. And if you are an aggressive investor, you can invest in more volatile and risky stocks. Remember that investing in a single company can be risky, so it is advisable to invest in a diversified portfolio with varying degrees of risk. There is no doubt that investing is a fundamental part of wealth creation, so it is important to understand how to invest and do your research before you start. Once you have this knowledge, there are many ways to invest and diversify your portfolio. Remember that while the market offers investors a way to grow their money, it is not without risk. So those who take the time to learn how the market works before jumping in will increase their chances of success.